Right now, 60% of American families are underinsured. Not slightly, dangerously. And the most expensive mistake most of them made wasn't buying too little insurance. It was buying the wrong kind. In the next 9 minutes, we're going to change that. Chapter 1. The $3.8 trillion misunderstanding. Here's what life insurance actually is, stripped of all the sales language. It is a contract. You pay a company a monthly premium. If you die while the contract is active, they pay your beneficiaries a lump sum called the death benefit. That's it. That's the whole product. But here's where Americans go wrong. Most people treat life insurance as an investment, a savings vehicle, or even a tax shelter. The industry encourages this. They have products designed to blur the line between insurance and investing. And those blurred lines cost ordinary people billions of dollars every single year. Life insurance exists for one reason: to replace your income when you die. If someone financially depends on you, a spouse, children, aging parents, and you died tomorrow, would they be okay? That is the question life insurance answers. Nothing more, nothing less. Chapter 2. The $500,000 difference. There are two main types of life insurance: term life insurance and permanent life insurance, the most popular form being whole life. Understanding the difference between these two products will save you over your lifetime, potentially hundreds of thousands of dollars. Term life insurance is exactly what it sounds like. You buy coverage for a specific term, 10, 20, or 30 years. During that term, if you die, your family gets the death benefit. When the term ends, the coverage ends. Simple, clean, cheap. A healthy 35-year-old can buy a $500,000 20-year term policy for as little as $25 a month. Whole life insurance never expires. It covers you until death, whenever that happens. It also builds what's called cash value over time, a savings component inside the policy. This sounds appealing, and that's exactly why it's so effectively marketed. A comparable whole life policy for the same healthy 35-year-old, between $300 and $600 per month, 10 to 20 times more expensive. For most Americans, that price gap is the difference between being insured and being broke. Chapter 3. The business model they don't put on billboards. Insurance companies are extraordinarily profitable. And to understand why, you need to understand three things: mortality tables, investment income, and lapse rates. Mortality tables are statistical maps of when people die. Actuaries, the mathematicians behind insurance, use 150 years of death data to calculate with remarkable precision the probability that a given person at a given age will die in any given year. The premiums you pay are calculated so that, across a large pool of policyholders, the company always collects more than it pays out. Always. But that's just the base. Insurance companies take those premiums and invest them, primarily in bonds, real estate, and equities. The investment income from holding your premiums is often larger than the profit from the mortality margin alone. And then there's the lapse rate. Industry research shows that roughly 30% of term life policies lapse, meaning people stop paying and the policy simply cancels. The company keeps every premium ever paid and owes nothing. When a policy lapses, the insurance company wins outright. This isn't sinister, it's math, but understanding it changes how you shop for coverage. Chapter 4. Your real number. Most people have no idea how much life insurance they actually need. They buy a policy because their employer offers it, or because an agent recommended a number, or because a round number like 500,000 sounded right. None of those are real answers. Here is the framework financial planners actually use. It's called DIME: debt, income, mortgage, and education. Debt: add up every debt your family would inherit if you died. Car loans, credit cards, personal loans. Income: multiply your annual income by 10, representing the investment your family would need to replace your salary indefinitely. Mortgage. Include your remaining mortgage balance so your family keeps the house. Education. If you have children, estimate the cost of their college education. Add those four numbers together. That is your coverage floor, the minimum your family needs to survive financially without you. For most American families, this number lands between $500,000 and $2 million. If your current coverage is $100,000, the typical employer plan, you're dangerously underinsured. By enough, the incremental cost of proper coverage is often smaller than you think. Chapter 5. The 4 mistakes that cost families everything. Mistake number 1. Relying entirely on employer-provided coverage. Employer plans typically offer 1 to 2 times your salary, a fraction of what your family needs. And when you leave that job, the coverage disappears. Individual coverage travels with you. Group coverage doesn't. Mistake number 2. Buying whole life as your primary policy. Unless you've maxed out every other tax-advantaged account, your 401k, your IRA, your HSA, whole life cash value is an expensive, illiquid way to save money. Buy term, invest the difference. Mistake number 3. Waiting. Every year you delay buying life insurance, the premiums go up, because actuaries know you're 1 year closer to death. A policy you could buy at $30 for $30 a month might cost $75 at $45. The cheapest time to buy is now. Mistake number 4. Naming the wrong beneficiary. 49% of Americans who die without updating their beneficiary designations leave money to an ex-spouse, an estranged relative, or no one at all. Review your beneficiaries every year. Update them after every major life event. Marriage, divorce, birth, death. Here's what we know. Life insurance isn't exciting. It's not the most compelling thing you'll think about today, but it might be the most important financial decision you make for the people you love most. The system is designed to confuse you into buying the wrong product, waiting too long, and leaving your family exposed. Now you know how it works. If this changed how you think about your coverage, subscribe to Insure Smart. We break down real insurance concepts every week so you can make decisions with confidence. Share this with someone who needs to hear it.